So you're a high income earner and you thought real estate would be the key to decrease how much you pay Uncle Sam, right? Because of course, real estate is one of those cool loophole deals that helps us decrease how much we pay in our taxes. Everybody's heard it before. Trump pays 0% in taxes because of real estate, but you bought real estate. You're not seeing any of those tax savings. So what gives? I'm going to answer that exact question in today's video. Here's the kicker, guys. I'm not a CPA. So eventually you're gonna have to take this strategy to your CPA and have the important conversation of how to actually implement this so that you don't end up in IRS jail. To make that conversation easier, I create a guide. It's literally a guide on how to have the Airbnb loophole conversation with your CPA. If you're interested, go down to the description below, click the link, and I will shoot you that PDF. To understand why you're not seeing the tax savings that you would like, you have to understand the difference between active and passive income. You're making active income in your W-2. Your real estate is a passive venture. So if you have any losses in there through depreciation, which I'll break down here in a second, but if you have any of those losses, you cannot offset active income with passive losses. Okay, so let's talk about these losses. Where do they come from and how do they come into play? So within real estate, of course, we've got income and expenses. And then we have depreciation. So income is your rental income. Expenses, of course, are things like lawn care, utilities, regular maintenance, maybe the interest payment on your loan. And then you have depreciation. Depreciation is a paper loss because it's not an actual dollar out of your pocket, but it is a loss that the government allows you, the IRS specifically, allows you to apply to that property. Now, there's two kinds of depreciation. There's accelerated depreciation, which we'll get to in a second, and there's standard depreciation, which most people use. Standard depreciation is the depreciation of that property over 27 and a half years, and it's only the building, not the land. So let's hit you up with an example here. Let's assume you bought a property worth $400K, but the land was worth $100K. So you're left with a $300,000 building. Now, if we divide that by 27 and a half years, we will get our standard depreciation every year, which would be $10,909. So let's assume that you made $10,000 that year in cash flow. Then you apply a $10,000 depreciation. Effectively, your tax burden is zero. According to the IRS, you didn't make any money that year because you applied standard depreciation. Now, here's the cool thing. Because we live in America, we like to supercharge stuff. So you can take accelerated depreciation. This gets a little bit more complicated. Accelerated depreciation is a process where we bring forward those depreciated losses to year one. We do that through a process called a cost segregation. So in a cost segregation, it takes your $300,000 building and breaks it down to buckets: 5, 7, 15, and 27 and a half years. And then it allows you to take everything between the 5, the 7, and the 15-year buckets and bring it forward to year one. So in this $300,000 building, you might have a bunch of components. Maybe you've got $100K worth of components. Think roofs, water heaters, ACs that are 15 years or less. And then the rest of the building is still a 27 and a half year quote unquote component. So there's your $200K. Still a $300,000 total, but now this $100K worth of loss can be brought forward to year one. Now you have a $100,000 loss in year one as opposed to a $10,000 loss in year one, and you still get this $200,000 divided by 27 and a half worth of depreciation thereafter. So accelerated depreciation is a great way to take a bunch of paper loss in year one and offset income, but we still run into that problem in the fact that this is a passive venture and therefore we're only offsetting passive income. So the IRS allows you to use Airbnb income or Airbnb losses because they see short-term rentals as active income. And anybody who's ever hosted an Airbnb before knows that that shit ain't passive. So thanks IRS for realizing that. But there are two criteria you need to meet in order to take advantage of this quote unquote loophole. The first box you have to check is that your average stay has to be 7 days or less. This makes sense because if you have people staying for 3 or 4 months at a time, it's pretty passive. So the active line in the sand the IRS drew is 7 days or less for an average stay. So if you have a few week-long stays, just make sure you have a few shorter days. That's pretty easy. Check. The second box, a little bit harder. Now, this is material participation, or MAT part on my board here. So material participation, basically this means that you are running your Airbnb. If you were to hire a property manager, then you are back to the passive side of our Great Wall, right? Because somebody else is running it, it's a passive venture for you. But if you self-manage, if you are putting the time and the effort in, you have to show that you're actively materially participating in the property. There are seven different ways you can check that box. But the one that is probably most applicable is the 100 hours and more than anyone else. 100 hours and more. So if you work more than 100 hours, 2 hours per week on this Airbnb, and more than anybody else, to include a property manager, to include cleaners, that's very important. So make sure you're tracking your hours. This is all about tracking. But if you have 100 hours and more than anybody else, you check the second box, and now you have access to the Airbnb loophole. And you might be thinking, hey, Greg, that might be hard to do, especially with my full-time job. Well, I've got a solution for you. This is how I would implement the Airbnb loophole here in Bryan-College Station so that you don't have to be an Airbnb host for the rest of your life, which can be pretty time consuming. And I'm assuming that you're a busy lawyer, doctor, or finance bro. So what I would do, check with your CPA for your specific situation, but what I would do would be to buy a property in July. In August, I would convert that to an Airbnb, earning the 100 hours I need to get material participation. Then I would rent it out for select weekends. 1, 2, 3 night stays during home games, right? Aggies, Kyle Field, 100,000 person stadium, home games, graduation weekends, ring weekends, parent weekends, very select weekends where I make the most amount of money. Because it's only select weekends, I know my average stay will be less than 7 days, and I know my cleaners will not work more in the property than I did to set it up. So now we have 7 days or less material participation. We have access to the Airbnb loophole. We then run a cost segregation and accelerate the depreciation. So we take most of our tax savings in year one, drastically offsetting your taxable income, lowering your tax burden. And then in year two, we just convert it back to a long-term rental and enjoy the appreciation and passive income that comes with owning a rental property in Bryan-College Station. If you want help implementing that strategy, if you want help self-managing your Airbnb, hit us up here at Schwartz Realty Group. All our contact information is in the description below. Shoot me an email. I'd love to help you out. And if you found this video valuable, hit the thumbs up button, subscribe, and until next week when I drop the next video, you take it easy.